So beyond silos, and yeah, one of the silos we want to take a look at today and see how we can bridge that silo is the silo between supply chain and finance. And as with the last or the previous webinars, I would like to start with asking you a couple of questions so that we can make this a bit interactive. So, and the first question I want to get to is, what's the biggest struggle? What do you experience as the biggest struggle, or what do you see as the biggest struggle? Why finance and supply chain work in silos, or when supply chain and finance work in silos? And again, you can join me at menti.com, either on your mobile phone or through your browser. And this is the code you can use, 3340-8520. And first question to get some of your input: what's the biggest struggle, when or why finance and supply chain work in silos? Different numbers, different goals, and so conflicting KPIs, other goals, sales forecasts and financial forecast not the same. So for sure I will come back to aligning the forecasts, no single version of the truth, misaligned decision making, the power dynamic between a realistic forecast and a target. Again, you should read the LinkedIn post or LinkedIn article, baby. Basically, I presented yesterday, but I also see issues here that sales made a certain commitment to finance, so then they will start over forecasting, and when we are in the budgeting period, they may start sandbagging. Yeah, finance focus on the next quarter, supply chain still ignoring the long-term financial impact. In general, there's two aspects to the comment here. So I indeed see that within finance, there's a lot of focus on the current quarter, and near the end of the current quarter on the next quarter. Most probably our S&OP processes are also a bit too much focused on the short term, and that's reinforced also by that financial focus. Supply chain still ignoring the long-term financial impact. Not sure what is meant with that. Financial targets and operational constraints are clashing, so we are not aligned. Do not get the supplier points. Not sure what is meant with this. Difficult to consolidate. I assume that's point of sale information and methodology in driving progress to drive objectives. Common goal, common vision. If they don't have a common purpose or the priorities don't match. And follow-up question: what do you see as the biggest opportunity? Yeah, and when finance and supply chain work in silos, so the opportunity is basically like, okay, if we would not be working in silos, yeah, what is the opportunity we are looking at? Yeah, we could say we will have one set of numbers, but what will that bring to the company? That could be the follow-on question here. Yeah, optimizing working capital. I've seen situations where sales was over forecasting in the supply chain forecast, and they were sandbagging in the financial forecast, and the difference is ending up in inventory and working capital. So there's for sure an impact on working capital. Clear decision making. Yeah. I was again yesterday. I was on the S&OP Flavor Day, and I was sitting at the table, and it's sometimes surprising how unclear the situation can be and how difficult it can be to get alignment between what sales thinks and what finance thinks and what supply chain thinks. I also believe that in supply chain and in S&OP, we have a challenge to more natively come up with scenarios. Scenarios should be a standard part of supply planning, I believe, but I'm not sure tools can support that. And less stress, yeah, very pragmatic, but it probably means that we don't lose energy, yeah? And we can spend our energy on the value adding discussions rather than on trying to bring plans together, which potentially could already be natively aligned. That's what I will try to come to. Bump on a bump on row C. Yeah. Okay. So thank you for those inputs. When we see, okay, what are things that could bring supply chain and finance together? It may be obvious for some of you that have been following me and some of our Solventure work for a longer period of time, but obviously a cornerstone for us is the supply chain triangle of service, cost, and cash, or more broadly, capital employed. And that supply chain triangle. So I have my 3 books here. Some of you might know them, but already in the first book here, Supply Chain Strategy and Financial Metrics, I introduced that triangle to try to summarize what I see as a key struggle with many supply chain managers. There's a lot of talking about end-to-end processes and information flows, but I saw that a lot of supply chain managers struggle with balancing the triangle of service, cost, and cash. And instead of cash, I use here capital employed. Capital employed is a financial concept, and it has 2 components. On the one hand, the working capital, on the other hand, the fixed assets. And I see companies struggle with balancing the triangle. Sometimes finance aggressively starts pushing on lowering the inventory because they want to lower the inventory to free up cash flow. Then we can end up with service issues. And if we have service issues, we have all kinds of operational firefighting costs, trying to close that service gap. I used that triangle to link supply chain to finance. And I said, okay, if I look at the triangle from an investor's perspective, the struggle we have in the triangle, I often say balancing the triangle is not optional, it's really mandatory. And to understand that, we take the investor's perspective, and the investor's perspective is that if we improve service, basically we do it to improve the top line, to either sell more in volume or to get a better price. And increasing service could be reducing lead times, improving on time and full delivery performance, having a broader product assortment, also having more frequent product updates and bringing you the latest and the newest and the best. And if I improve service, it should basically help me to drive more sales. As an investor, I'm concerned with more than just the sales or a top line metric like growth. At least in the long run, I also want to see a margin. And if I combine the top line with the cost, I get to the bottom line. Could use EBIT here, earnings before interest and taxes. So if you have 2 companies generating 50 million of EBIT, the first company requires 50 million of capital employed. The second company requires 100 million of capital employed. Then obviously I prefer to be in the first company. So the investor's perspective is that it is all about, okay, what's the EBIT you generate over the capital employed? In financial terms, the return on capital employed, or the ROCE. That's a return metric. And some companies use an alternative. They say, okay, I start from the EBIT and I account for the capital employed in the following way. I look at what is the capital employed, the working capital and the fixed assets, for instance, in a certain business unit. I multiply that with the weighted average cost of capital, or the WACC. I subtract that capital employed cost, you could say, from the EBIT, and that's the EVA, or the economic value add. And okay, so this is some financial lingo. If we want to bridge the silos between supply chain and finance, we will need to learn to talk the finance language. And so if this is difficult or new, read one of the books. I think on the website, Bram Desmet, there is also like the appendix of the books is there, which with like a finance primer. And the triangle really connects supply chain to finance. Supply chain is on the left. You could say finance is here on the right. And so we have the same objective. Both of us try to drive value for the company as measured through that return on capital employed or economic value add. And we try to do it by better balancing that triangle. And that return metric or that economic value add also connect margin metrics or P&L metrics with the capital employed, which is a balance sheet type of metric. The triangle also allows to link to strategy. Typically, if you are a lowest price player, you may have minimum margins, but you will also work with a minimum capital employed. You won't have a long tail of slow-moving products because that's bad for the cost. And if it's bad for the cost, it's bad for your strategic positioning of the lowest price. So lowest price players will typically work minimal margins, but also minimum capital employed. If you start differentiating broader product portfolios, more complex products, you will need more working capital. It will be less easy to utilize the assets at the same level. So pro rata also more assets, so more capital employed. But if the strategy is executed correctly, you will be able to compensate with a higher EBIT. So different strategies are also different ways to drive the same return on capital employed. I always want to have 15% ROCE, but I may come to that 15% in a different ratio of EBIT versus capital employed, and that's defined by the strategy. Again, if this is new for you, this is all described in the first two books. And when I started reading financial reports, I didn't see the ROCE as a common financial metric. I need to say that over the last 10 years, it has become more common. And I do believe it's a very relevant metric for operational companies because EBIT is a very tangible metric. Capital employed is something very tangible. So that's that ROCE is very helpful for me. But I see that finance sometimes is much more concerned about the free cash flow. And what is the free cash flow? The free cash flow basically starts from the EBIT. The free cash flow is the cash flow available to all security holders. And what are the security holders? It's on the one hand the debt holders, the banks. On the other hand, it's the equity holders, the share holders. The free cash flow measures, okay, what's the cash flow we have available for these two? How do I get to the free cash flow? Well, I start from the EBIT, but I do subtract the taxes because the taxes is to the government. The taxes will not go to the banks or to the shareholders. The interest will still go to the debt holders. So we don't subtract the interest. So if we subtract the taxes from the EBIT, that gives me the NOPAT, the net operating profit after tax. And if I look at my capital employed, so if my working capital increases, it's going to consume cash flow. If my net assets, my CapEx minus my depreciation is positive, if the net assets increase, again, it's going to consume cash flow. That's why finance typically wants inventories to go down, because if my working capital goes down, it's adding to the NOPAT and it's adding to the free cash flow. But these are two ways to measure financial value. And both obviously can easily be linked to the triangle. And again, so finance and supply chain, if you look to connect the two, I think that the triangle is really like the connector that can easily be used. In my last book, I added the Rethinking Supply Chain book. I expanded to sustainability and I said, we need to operate this base triangle or this profit triangle within certain limitations of a social foundation and an environmental ceiling. If I'm in procurement today, it's not only about the cost and the quality, but it's also about, are my suppliers behaving in a socially responsible way? And when I'm in manufacturing or logistics, it's not only about the on time and about the cost, but it's also what's the CO2 I'm emitting. And our CO2 targets are getting more strict, so the ceiling is coming down, the foundation is coming up. So the room we have to operate our core triangle is getting smaller and smaller. It also means that the room we have to drive that financial value is getting smaller and smaller. And we call that our Solventure Sustainable Value Generation Canvas. If I want to drive sustainable value, I will need to understand how these things interact. And if it needs to be sustainable value, then I need to make sure I'm not only looking at financial metrics, but also at my social foundation and my environmental ceiling. And I think this is the basis to connect the two. And again, some of the language is high finance lingo, like NOPAT, not net operating profit after tax. It sounds difficult. If you understand what it means, it is not difficult, but it's a barrier we will need to get across also as supply chain folks. If we want to better connect with finance, we need to understand to talk the finance language. If you want to know more, read one of the books, and I think on the website there is also like a finance basics or a finance primer which explains some of these base financial metrics. And then there is two ways I think we can jointly drive value. One is more linked to performance management, performance transformation. So if I know my metrics, how do I come up with targets? I see that companies really struggle. And once I know where to go with my targets, how do I drive performance? I will briefly touch upon that. And then the second thing is planning. So once I identify targets and I start working towards the targets, there's always low-hanging fruit. But if I want to sustainably drive value, whether I like it or not, I will also need professional planning processes. And on the planning side, I will take a look with you on how I believe we can better connect supply chain planning and financial planning. But let me start with that performance thing. So when we do a performance analysis or a complexity analysis, we use a lot of these graphs. So the PLs here, you see our product lines, and it's an anonymized data set. And on the horizontal axis, we typically show a capital employed metric. So here it's inventory turns. I could also look at day sales outstanding. I could look at the cash conversion cycle. I could look at fixed asset turns. And on the vertical axis, we look at a margin metric. So at the bottom, we look at the P&L, at the balance sheet, sorry. And here at the vertical axis, we look at the margin metric or at the P&L. And here we are looking at gross margin. We could also look at EBIT or EBITDA. But from a distance, gross margin means it's the sales price, and we subtract all the operational cost, the cost of goods sold. And inventory for sure is the hardest element of working capital. So let's look at inventory turns. And if this is how your portfolio looks like, what do you see? Open question. What I see is chaos. It's all over the place. So I see product lines with very low inventory turns, less than 1. So it's almost like spare parts and a very low gross margin. And then I see product lines which have inventory turns of 10 with a gross margin of 40%. And again, this is not fictitious data. It's anonymized real life data. And how do you make sense of this? Well, what we can do is we can plot trade-off curves. And what are trade-off curves? It are all the combinations of inventory turns and gross margins that lead to a same return metric. And we can look at the lower quartile, we can look at the median, we can look at the upper quartile. This is your data. We can also plot competitor data. Starting from obviously publicly available data. We're not going to use private data. And if I would look at the median curve here, so basically it says, yeah, it's okay that I have a bit more inventory or that my turns are lower as long as I can compensate with a higher gross margin. Or if it's okay that my gross margin is a bit lower as long as I can compensate with higher inventory turns. And so that's the bang for the buck perspective that we take. Yeah? And stuff that is more commoditized would typically be more at the bottom right. Yeah? Stuff which is more specialized or more premium typically is more found top left. And once we plot our own curves or competitor curves, we can start thinking through, okay, what can we do to move the products lines here, which are at the bottom left? And what can on the one hand be done to move them up? So can we increase sales prices? Can we do a cost down of the product? Or what can be done to move right? So for some of the product lines which are over here, yeah, how come that we have so much inventory? And yeah, either we keep the inventory, but if the customer doesn't pay for the product, maybe you should pay for the inventory service. That would increase the sales price and move us up. And if the customer is not willing to pay, yeah, then maybe we need to switch from make to stock to make to order. Or instead of keeping inventory with us and with the customer, we should go to a kind of a vendor managed inventory, which would basically allow us to skip our inventory. And instead of waiting for the customer order, once we produce, ship it to the customer. But basically, we try to find ways to start moving product lines. Yeah? And as we start moving product lines, yeah, we will basically also shift our curves. And so I think that's an analysis we do more from a performance perspective. Yeah? It's helping supply chain because it's about reducing complexity. And it's about adding value. And I also believe it's an exercise that, because we will need a lot of financial data, it's something that we could do together with finance. So for that reason, let me ask you the question here. Are you working together with finance on managing portfolio complexity? Yes or no? Do you believe it makes sense? And so how do we bridge the silos? Yeah, happy to hear from you. Would it make sense? No and yes. Feel free to add some comments in. We don't, but it makes sense. Yes, we are. Yes, yes. So we are working and it does make sense. Yes, I am in finance. I work together with supply chain. Okay, no and yes. Now I get to no and yes. And so we are not working together with finance on portfolio complexity. And yes, it makes sense. Not yet, but raising awareness. And I think what is dangerous in the target setting is I even got a call last week and somebody said, yeah, we got a target from finance to reduce inventories with 30%. Yeah. And yeah, if I'm a customer intimacy player with a very broad portfolio, I don't want to have the target from a commodity player or a lowest price player. So when you set targets for inventory turns, it's really important that you understand your strategic positioning and that you take that strategic positioning into account. Again, that strategic target setting and benchmarking has been explained in the first two books. And once you kind of have the overall understanding, yeah, you can obviously set targets on a company level or on a business unit level, but then you need to drill down. You need to start working on portfolios. And yeah, when you want to clean up portfolios or reduce SKUs, sales will never like it. And I think that there's a big opportunity for finance and supply chain here to be allies. I think finance may have the power in the organization, but I do believe that supply chain has the insights on what are the operational complexities involved and where are the possible options to shift the curve and optimize the curve. Thank you for your inputs here. So second topic I wanted to explore is, I would say leverage planning processes and FP&A. But zooming in a bit here on the integration between operational planning and financial planning. And I have a graph on that on the next slide. But when we are doing APS implementations today, I always ask for a meeting with finance. And the narrative I bring to the finance people is I say, okay, listen, when we are doing the effort to implement an S&OP process and a planning system, there's no way why, if we have a volume forecast, if we had the sales price, we would not get to a gross sales forecast and or a gross revenue forecast. And if we take into account discounts, there's no reason we should not get to a rolling net sales forecast. And at least we should add standard cost prices, yes, so that we get at least based on standard costing to a kind of a gross margin forecast. But as I will show in a bit more detail, in that planning engine, we know what the variable labor costs are. We know what the material consumption will be. So it's basically not that difficult to say, okay, what will be the variable material cost? What will be the variable labor costs? So what will be like a rolling projected margin over variable costs? And once we know what are the fixed costs, it's also not that difficult based on variable and fixed costs to come to like a projected and rolling gross margin forecast. And when I explain that to finance, there is a lot of interest on the finance side. I typically have to convince the supply chain people, because it's the supply chain people that would tell me, oh, Bram, why do we make it so difficult? And can we not just stick to balancing the plan in volume? And I will come back to that later. And once we have a sales forecast, basically out of the supply chain plan, we also know the inventory projection. Out of the supply chain plan, we also know what we are going to buy. So when we take the sales forecast and we add the payment terms, we get the receivables forecast. When we look at the inventories and the inventory evolution, we get to an inventory forecast. When I know what I'm going to buy, at least for key raw materials, I also know my payables forecast. So I can basically come to a working capital forecast. And that working capital forecast, for instance, when I have seasonal stocks, can be crucial to come to a cash flow forecast. So again, if I explain that to finance, I would say finance is highly interested. And I typically need to convince the supply chain folks, because it's the supply chain folks who then say, but why do we make it that difficult? And is this really needed? If you want to overcome some of the issues we started with, I do believe that it is needed. And this is just the illustration. Again, if I take my forecast in volumes and I add the sales prices, I get to the gross revenue. If I subtract any discounts I'm giving, I get to the net revenue. If I make a production plan, I know what will be the variable material cost. So I can get to a kind of a margin which accounts for the variable material costs. If I account for the variable labor cost, which I know in my production plan, I can get to a contribution margin. And if I add my overhead cost or my fixed costs, I should be able to derive a gross margin forecast. And once I have my sales forecast, if I had the payment terms, I have a receivables forecast. I have my inventory plan. So if I monetize it, I have an inventory forecast. I know what I'm going to buy, so I have a payables forecast. So I basically have a working capital forecast, which again, especially if I have some seasonality in the inventories or the sales, can be key in driving a good cash forecast. Yeah? And if we don't deliver it to finance, finance will have to invent it on its own. And so when I'm talking to companies about implementing APS tools or S&OP, I typically try to position like there's no reason why we shouldn't have this as an output also of the APS plan. I'm not a fan of making a budget in an APS tools. APS tools are not made for that. And also this is, I think in the last two books, if you look at the budget, what are the different components of a financial budget? We start from a sales forecast or a sales budget. We use bums and routings to understand, okay, what will be the production plan and what will be the associated costs. Yeah? I have my variable production cost, I have my fixed production cost, that gives me the cost of goods. Sales revenue minus cost of goods gives me the gross margin. And if I subtract the SG&A, I get to the EBIT. So again, if we want to understand finance, we will need to make sure that we understand how this works. And if this is really like the high level picture, this is a more detailed picture. I'm not going to explain all of the details here, but let me just say this, if I sell 40,000 units and I produce 40,800, it means that my inventory of finished goods will go up with 800 units. And this again links to the inventory forecasts or the working capital forecast. If I make a production budget or a production plan, I will need to understand the amount of direct materials I need. If the requirement is 81, but I buy a bit more, why? Because maybe it's seasonal buying or I expect a price increase. Yeah. Also, my inventory of raw materials may go up. And that again ties into the working capital forecast. Yeah. And if I zoom out, what I've argumented before is this is basically how a financial budget works. And if you see the gray zone here, all of the gray zone, I believe, are core capabilities from S&OP and supply chain planning tools. And there's no reason why we wouldn't drive these type of calculations on a rolling basis from an APS tool. And what do we then still need if we want to come to a budget? Well, for sure, we need the SG&A costs. You're not going to model that in your APS tool. Yeah, we still need the CapEx and the depreciations because that's needed for the cash flow budget. We're also not going to manage that in an APS tool. But what you clearly see is I think finance could much better and usually leverage the whole investment we do here in supply chain. If I talk to finance people in general, they are quite enthusiastic. And the hardest people to convince are more often the supply chain people, even not the finance folks. I see some questions here coming in the question box. We will open for questions later, but before we do that, let me switch back to the Mentimeter and listen with you. So I think, if you want to connect finance and supply chain, I think that supply chain triangle is really a good starting point because it allows to neatly connect the two. Anything that has to do with complexity management, portfolio management, performance optimization, as I discussed. Yes, obviously, not only finance and supply chain are involved, but if we join forces there, I think supply chain has the operational knowledge and finance has the power. So we can jointly drive a lot of value there. And I also see a lot of value in more natively aligning the financial plan and the supply chain plan. And so my question here to you is finance leveraging the supply chain plan, and to which degree? So Yes, AP and AP. Depends on the IBP and adoption of it. Usually, to my experience, we hold meetings to align, but the adoption rate is too low, in my opinion, and reaching a common language is hard. Yeah, so one of the issues I have with IBP and S&OP in the traditional form is that it is still finance is making its plan, supply chain is making its plan. We monetize the plan, and then we try to align the two plans. And so we try to align at the end. What I tried to explain in the previous slide is no, we don't need to align at the end. We need to align at the start. That's the opportunity I see. Is finance leveraging the supply chain plan? In some companies they do, which means the supply fails in any respect, either too much inventory or stock breaks. Not fully understand the comment here. If the supply fails, yeah, so I think the challenge is if we better align the two plans, we'd better make sure that our supply plan is correct, because indeed, if the supply plan fails, it will directly impact the financials. And I think that's the situation we want to be in. To some extent, quite well synced from the beginning in these last years. That's my vision. I believe that's where we should go. Usually not enough, and not in the way supply chain wishes they would. More realistic plan in terms of product mix versus individual budget mix. Yeah. So finance does indeed use the S&OP plan as a basis for their running forecast, but as part of a big multinational, reducing, adding somewhat for political reasons. Yeah. I do accept that finance, I often say finance takes a commitment, like, so if the S&OP plan is 120, I do understand that finance sometimes says we are only going to commit to 115. Yeah? As long as it's based on the same plan, I think it's perfectly fine. Yes, you're right, collaboration from the start is key, but does not go like that, but it does not go like that. That's what I assume. So, okay, thank you for giving your perspective on this. Maybe I'm biased, but I would at least encourage you, as I told you, like when we are doing implementations today and when I'm involved, which is obviously not always the case, I always ask for a meeting together with finance, and I always put on the table, like, when you do this, there's no reason you wouldn't see a gross sales, net sales, gross margin, working capital forecast as a result. I see a lot of enthusiasm with finance, so at least look for that discussion. As I said many times here, my bigger challenge has not been convincing finance. My bigger challenge has been to convince supply chain. And we're happy to open for any generic questions you would have. At what level of detail should supply chain translate this data for finance? Do we need to push financialized data at the SKU level? Or is an aggregated product family level sufficient to build trust with the finance team? I think it will depend company per company, but I think there's a lot of data available on the SKU level. So at least when it's about margin over variable cost, variable material cost, variable production cost, there's no reason we shouldn't do it on the SKU level. And people push back on me and say, hey, Bram, but finance is complex. And I say, I disagree. Finance is also just about adding and subtracting and multiplying and dividing and the rules of three. And even if finance is complex, it doesn't justify to create a parallel universe where nobody understands what finance is doing and is creating a black box for the supply chain organization. We also have a responsibility to bring good financial data to the supply chain folks, because the supply chain folks are making decisions on a daily basis. So I would say in general, it depends a bit on the company, but yes, SKU level as far as possible. Alignment comes from a tool adoption or executive pressure or something else. I think it will not come from the tools. I think the tools are typically a good excuse to start a process discussion. And I think it's about, it starts with creating awareness, because the average supply chain person doesn't understand finance enough to understand the finance opportunity and to connect with finance. The average finance person does not understand supply chain enough. I would say it probably starts with education and creating awareness. It's easier to align with finance than with the supply chain teams. I recognize this, but I'm curious about your perspective. Yeah. So what I need to explain to supply chain people, the supply chain people have a tendency to fall back on what they control, which is the volume plan. And I need to explain to supply chain people, like, if you want to solve your supply chain plan, you will need to take a broader perspective, because if not only you are looking at the forecast, but finance is also looking at the same forecast, there's two pairs of eyes looking at the same forecast, and that will basically help you to get a more accurate forecast. If the worst situation is if sales submits a forecast to you and a separate forecast to finance, you will get gaming. But as supply chain, we don't feel responsible like for the value optimization. Yeah? So we try to avoid the discussion with finance, the discussion with sales. Yeah? We try to focus on what we more directly control. But by focusing on a smaller parameter, yeah, we keep stuck in some of the issues we started with. Maybe last question, because I don't want to keep taking too much of your time. A lot of promo unknown, more complicated to align finance forecast and supply forecast. So yeah, when your business is promo driven or when it's standard driven, it's adding to the complexity. But again, extra complexity is no reason not to do it. Yeah? If the complexity is there, you always need to solve it. And then you'd better solve it once in a joint plan than solving some of it in the supply chain plan, like what's the promo uplift, and solving some of it on the financial side. Yeah, like, okay, what is then the cost impact, and what is the efficiency of the promos we do know again. So yeah, complexity makes it more complex, but the worst thing to do is then create a parallel universe and start solving the problems 2 times in disconnected ways. That only makes the problem bigger. It will never make the problem smaller. And I will have to stop here again, because I'm already 5 minutes over time. So I would say thank you so much for joining. This was for sure one of the best attended webinars, which clearly shows that this is a hot question in many companies. It's also a topic of personal interest to me. I would say it's a topic of special interest to Solventure. So how to better integrate plans, and not just supply chain plans, but also financial plans and sales plans. I see a big opportunity in general to drive more sustainable value. That's where I started with in the beginning. I truly believe that yeah, finance and supply chain could be powerful allies. I think supply chain has a lot of the operational knowledge, and finance has the power in the company that supply chain historically doesn't have. Where if we combine the two, we can realize a lot more. And as I started with from the triangle, yeah, we clearly have the same objective. The two of us want to drive value, and the way to do that is, yeah, to better optimize that supply chain triangle, which I really started with. We can do that through better managing complexity and financial performance or performance management, and we for sure can make a big step in better integrating our plans, yeah, which will avoid confusion, double plans, conflicting objectives, more joint decision making and more clarity for everybody in the organization. So thank you, and hope to see you back next time.